Hey everybody, it's Steve Olson with the Peak Group. Today we're going to talk about stopping that waiting for the perfect rate and why trying to time that market is killing your returns. What if I told you that one of the biggest wealth building mistakes individual real estate investors make has nothing to do with picking the wrong market, choosing the wrong tenant, or even overpaying for a property? It's this: waiting for the perfect interest rate before pulling the trigger. By the way, guilty as charged. I've done it too. Today, we're going to break that down. I'm going to use two very different deals that are actual deals that I've recently been involved in to show you exactly why this mindset is costing everyday investors time, equity, and opportunity. One is a single family rental. The other is a 48-unit apartment complex I'm the general partner on in the state of Idaho. Same concept, interest rates, but completely different rules of engagement depending on where you are playing as an investor. So I'll paint a picture that I hear a lot. An investor finds a great single family home, or maybe a duplex or a fourplex, and the numbers pencil, the rent covers the mortgage with room to spare, cash flow looks solid, but then they say, I think I'm going to wait, rates might come down in the next 6 months, or maybe pricing might come down in the next 6 months. So they wait, and 6 months pass. Maybe rates tick down a quarter point. Maybe they didn't move at all. Maybe they actually went up. Either way, that deal they were looking at is gone. Somebody else bought it. Rents have kept climbing. They're still sitting on those sidelines. And here's the thing about residential real estate. And I'm talking 1 to 4 units conventional financing, 30-year fixed rates. The rate you get when you close is not your rate forever. It's your starting point. When you buy a deal that cash flows at today's rate, you've locked in 3 things that matter. You've locked in the purchase price, you've locked in your basis, and you've locked in access to the asset. The rate, that's one variable in this equation that you can change later. Refinancing is a tool. It's always available to you as long as the asset is performing and you own it. So think about that. If you buy a fourplex today at a 7% rate and the numbers work, you're covering expenses, you're cash flowing even modestly, you're building equity, and then in 2 years rates drop to 5.5, you can refinance. Boom. Your payment drops. Your cash flow improves. Your deal just got better while you were sleeping. But here's what you can't do. You can't go back in time and buy that property at 2021 prices because you were waiting for 2021 rates in 2024 or 5 or 6. The cost of waiting isn't zero. It has a price, and that price is opportunity, not to mention the fact that your money wasn't working for you during all of that time. We make money when investors buy properties from us at the Peak Group. So this can sound sort of self-serving, and I get it. But I also believe it. I've lived it myself. If the deal makes sense today and you've got capital, you're not going to outsmart interest rates. I just finished a refinance on a duplex that I had a 4.5% rate on, and I refinanced up to 6.5%. I sound like an idiot. I was able to pull out a ton of equity. My rents had gone up so much, I still have a really healthy cash flow, and I take that money and I acquired more properties that also make sense, right? So once again, they have that cheesy saying that realtors say, oh, marry the property, date the rate. It's kind of corny, but I don't think that it's entirely wrong. If the deal makes sense today, you can make it better over time as rates dip. But if rates go up, you're going to be happy that you bought that deal. So let's go into our second example. This is, well, actually, you know what? Let's go with a back of the napkin deal so that it lands a little better. Say you're looking at a fourplex. It's 4 units. They rent for $1,000 a door. So $1,000 a month per unit. You're in it for $400,000. You put 25% down. It's $100,000. So you finance that $300,000 at say 7%. Your principal and interest payment is right around $2,000 a month. Add taxes, insurance, maintenance, vacancy reserves. Let's call total expenses at $3,500 a month. You're cash flowing $500 a month. That's $6,000 a year on $100,000. That's a 6% cash on cash return in today's market. And that's, above the treasury, so it's not bad. And you haven't even factored in appreciation and debt pay down yet. Now fast forward 2 years. Maybe rates have dropped to 5.5. You refinance that same $300,000. Actually, your balance is a little lower now, but we're going to call it a wash for simplicity. So your new principal and interest payment, about $1,700. That's $300 less per month. You just went from $500 cash flow to $800 cash flow with 0 additional investment on your part. Same property, same tenants, better deal. That's the refinance as a future weapon. You deploy it when the opportunity presents itself. But you can only do that if you own the asset. Now, contrast that with what happens if you're still waiting on the sidelines for a lower rate to buy. You've got no asset. You've got no equity, no building. You're not in the game. There's no tenant paying down your mortgage. You have nothing to refinance. Waiting isn't a strategy. Owning the property and then timing those refinances is a strategy. I hammer a lot on how we can't time the market. Well, if you own the property and rates go down, you can time that, right? And that's a key idea. But if you don't own the property, you're not even in the game. Let's talk about when timing does matter, right? This is where it gets interesting because the context is really important. Everything I just said applies brilliantly to 1 to 4 unit residential deals with conventional financing. But I want to show you why the calculus completely changes when you step into institutional grade commercial real estate. I'm currently the general partner on a 48 unit apartment community in Boise, Idaho. It's a great asset. We are 100% occupied, got some turnovers coming, but we're getting renewals in. We'll probably drop into the 96s, right? It's got good market fundamentals, and we're in the process of refinancing through a HUD 223F loan. For those of you that don't know, a HUD 223F loan, it's a government-backed, long-term, non-recourse financing deal for multifamily properties. We're talking about like a 35-year amortization, competitive rates, and great terms. For a stabilized multifamily asset, it's one of the best loan products in the country. They're a pain in the butt to get. They take forever, but once you got it, it's hard to beat. But this is a significant but. They come with substantial prepayment penalties. Typically a 10-year lockout followed by a step-down premium. What that means in English is if you want to get out of this loan early by paying it off or refinancing it, you're going to write a very large check to do it. So on a deal like this, you have one shot to get that rate right. You can't buy it today at a 7% HUD rate and casually refinance in 2 years when rates drop. The cost to exit that loan could be hundreds of thousands of dollars. And that changes everything. On this 48 unit, our team spent months analyzing the rate environment. When do we pull the trigger? Do we wait for the Fed to move? Do we lock now and take that risk when rates drop after closing? What about Iran? These are all real conversations that require a lot of sophisticated analysis. And we're looking at rate lock windows, forward commitments, treasury spreads. It's a completely different game. And you know what? The level of analysis is appropriate for a deal of this size. We're talking about a loan north of $8 million. A quarter-point difference in rate on that balance over 35 years is a big number. The timing matters. Getting it right has real financial consequences. And so that's what I mean when I say the rules change at scale. Institutional investing demands a different level of market engagement and timing discipline. That's not market timing as a bad habit. It's fiduciary responsibility to our investors, right? So let's bring this full circle because I think the contrast here is really instructive. If you're an individual investor buying a single-family home, a duplex, or a fourplex, you're in the most forgiving financing environment in real estate. You have 30-year fixed-rate debt. You can refinance as many times as it makes financial sense to do so. There are no lockouts, no yield maintenance, no defeasance. If rates drop, you call your lender, you improve your position. Your job is not to time the market. Your job is to find assets that work at today's numbers, buy them, and hold them. Refinancing is a bonus, a future option you keep in your pocket. Let the asset appreciate, let the tenant pay down your debt, let inflation erode the real cost of that fixed mortgage payment over time. Those are tailwinds of long-term real estate investing. And the investors who build real wealth in residential real estate are not the ones who waited for a 5% rate to come back. They're the ones who bought when the deal made sense, managed the asset well, and captured the refinance opportunity when the opportunity showed up. Now, if you graduate to larger assets, if you step into commercial, into multifamily at scale, into HUD financing or CMBS debt, then yeah, the conversation changes. At that level, rate timing is part of the strategy. The loan structures demand it. But that's a sign that you've moved into a more sophisticated tier of investing. Not that you should have been timing the market all along on your fourplexes. The bottom line, don't let the complexity of institutional real estate bleed into the simplicity of individual investing. They're different games. Play them accordingly. So, just to conclude, if you're sitting on the sidelines waiting for rates to drop before you make a move, if you want to take a hard look at what that's actually costing you, not just in cash flow and equity and in time, the deals that won't be there when you finally decide the moment is right. Those deals won't be there when you decide. So at the P Group, we work with investors every day who are ready to stop waiting and start building. We've got deals that cash flow today at today's rates. And if you invest in one of those properties and rates stay flat or go up 3 years from now, you're going to be glad you had your money working for you, getting cash flow and tax benefits. And if those rates go down, refi that thing. I know I've beat this horse. It's pretty dead, but I'm pretty passionate about the topic. Thanks for joining. We'll catch you on the next episode.